Hello everyone. Good evening for this webinar on very unique subject, which is normally untouched area of the normal webinars. Normally webinars have some capital gains or profit or gains of business and all that. This is the first time Direct Tax Committee has thought to have some untouched area of clubbing of income under Chapter 5. Normally, young members or even other side also, they are not much aware or much keen on this clubbing of income under Income Tax Act. So for this, we have a speaker with us, C.A. Satish Gupta ji, and I also welcome Chairman of Direct Tax Committee, C.V. Chitre sir, also Vice Chairman of Direct Tax Committee, C.A. Raj Chawla sir. I request Chairman of the Direct Tax Committee, C.V. Chitre sir, to have some opening remark, please.
Vice Chairman will offer first remarks, then I will talk.
Okay.
Dr. Raj Chawla, you first.
I request Vice Chairman sir, Raj Chawla sir, to have opening remarks, please.
Thank you, Doshiji. Good evening to all. First of all, I welcome our Honorable C.A. Satish Gupta ji, our eminent speaker for today, topic on clubbing of income under Chapter 5 of the Income Tax Act. And I also welcome C.A. Atul Doshi ji, our MOC for today program. And I also welcome my chairman, Direct Tax Committee, C.A. Chitare sir, who is so kind. He always give me the opportunity to interact with all of you. And I also welcome all the members present here to see this our today's webinar on this Chapter 5. So with this, now I request Atul Doshi ji to please start the proceeding.
I request Chitre sir, Chairman of Direct Tax Committee, to speak a few words.
Well, thank you. Friends, this is indeed a very important session because as you know that July is fast approaching and the whole profession will be engrossed in competition of total incomes. So the Direct Tax Committee, myself and CA Dr. Raj Chawla, we had deliberations and it was thought fit that before the profession is going into this exercise of competition of income, let us refresh all the knowledge about compilation of return of income, which would go a long way in increasing the standard of their competition. And there would be no misgivings because, you know, nowadays if there is any error, the atmosphere is very litigious. And maybe even a chartered accountant may be taken to the court of law if the calculation is erroneous and the assessee faces some penalty or some other consequences. When we talk of computation of income, typically we consider what is salary, house property, capital gains, and so on. What are the incomes? What are the expenses? That is true. That will go a long way in computation of income. But then one important aspect that one has to keep in mind that whenever we are computing income and paying tax, it is not only the income that is earned by the assessee that is subjected to tax, but also certain incomes which is earned by certain other persons who are near and dear to him, say his spouse or minor child, or maybe wherever in case of HF they have given gift. So all those incomes which are popularly called as clubbing provisions, they are contained in Chapter 5. And at times, if you miss your attention from these sections or provisions, it would be incorrect computation. Let us try to understand what are the nitty-gritties of this particular chapter and how we should compute the income considering the provisions of clubbing, or under what circumstances the clubbing may not be applicable. So all those aspects are very necessary to understand, and also maybe in appropriate cases plan the affairs of the assessee. So we have with us former Vice Chairman of Direct Taxes Committee, C.A. Satish Gupta, who has been very widely and thickly associated with the field of direct taxes for more than 2 decades past. He is also heading this Rajasthan Tax Bar Association, and he has, if I may say, on earlier occasions, he had knocked the doors of finance minister and she had readily welcomed him and accepted his presentations. So we are thankful to you, Satish Bhai, for accepting our invitation, and we are sure that we are in for very enlightening section. Over to you, Atul.
Thank you very much, sir, for your enlightening words. And before we start the session, I'd like to formally introduce today's speaker, CA Satish Kumar Gupta ji. He is a senior partner in tax and litigation in Gupta Garg and Company. He was former Central Council member for 2019 to 2022. Was chairman for SMP committee of SAFA. He was heading so many vice chairmanships during his tenure of Central Council, and he was also former chairman of Jaipur branch, and he has delivered so many papers. He has written so many papers and lectures over a period of time. So we are very fortunate to we have faculty like you, sir. We welcome you on this occasion, and I over to you, sir. Over to you, sir.
Thank you, Atul ji. C.A. Chandrasekhar Chitle ji, Honorable Chairman Directors Committee, Central Council member, and my brother, and I can assure you, friends, under his dynamic leadership, Direct Tax Committee has done wonders and is going to do wonders. And this year, C.A. Dr. Raj Chawla has joined him as the Vice Chairman. I think it will be, in Hindi we say, Sone Pe Suhaga. So it's really wonderful to see this pair of leaders heading the Directors Committee of the Institute of Chartered Accountants of India, our mother body. And I hope under their able leadership, we will touch no stone unturned and we will touch newer heights in the profession. Chandrasekhar Chitle sir is a person who has a very vast knowledge on taxation, on company law, on accounting standards, and other audit standards, etc. He is a person who is, I can say, he loves working a lot. He does very hard work, and he does the work to the best of the satisfaction levels. So I know Chitle sir, and I believe that under his leadership, we are going to touch newer heights. This topic, rather this idea which he has brought this time is that it will help a lot to our members in compilation of the returns of income. As rightly stated by Chitle sir, that nowadays our profession is having several threats if we compromise with the qualities. And friends, when we discussed that what topic we should take for me, I requested him to give me topic of this clubbing of income, because I personally feel that this topic is not in our memories from last several years to check where whenever we go for the filing of return of income, we forget the complications of this chapter, and it is very important. So thank you, Chitle sir, for holding this particular topic for me today, and thank you, Raj Chawla ji, for giving me this opportunity to give my views on this wonderful topic, clubbing of incomes. Yes, friends, we have Atul Doshi ji with us as a coordinator of this today's program. He is past chairman of the Satara branch, and he's a very senior chartered accountant. And I think with him, we will feel a very comfort, and we will bring several issues for the benefit of our members and for the benefit of our profession. So now I come on the topic. And before I come on the screen and I share my screen, I would like to tell friends that clubbing of income under chapter 5 is a very important topic. Important in the sense that although there are only 6 sections, and if we include the subsection, the only 11 sections or subsections we are going to take today. This is chapter 5 of the Income Tax Act. And friends, but why a question should come in our mind that when we have section 4, which specifically and clearly says that income tax shall be charged on every person for any assessment year at any rate or rates in accordance with provisions of this act of the previous year. So why the question of clubbing of income does come. This is very important thing which we should understand as a, in the beginning. So friends, I think that these provisions these are not in new, or these are not only in the Income Tax Act 1961. The history of these sections are coming from the 1922 Act even. So the very purpose to bring these provisions was to avoid the avoidance of taxes. What it was, otherwise it would have been quite easy for an assessee to arrange his affairs in the manner that he could have transferred his income to his near and dears, and therefore he could have saved the taxes. So these provisions have been brought to the Income Tax Act just to ensure that there is no avoidance of taxes. Friends, we will discuss today section 60 to 65, and in section 64 we would take section 64 1 clause 2nd, clause 4, clause 6, clause 7, clause 8. Thereafter we will take 64 1A and 64 2. So these, and 65. So we will take all these sections today, and we would try to bring certain things which are very important and which as a professional we should take care of. Before I come on the sections, I would like to describe certain situations just to introduce you the entire chapter by giving some examples. Friends, the first one is, suppose A is the owner of an asset which is yielding the income, and A has transferred that asset to the other person without, sorry, he has transferred the income without transferring the assets. So this is the first case which is section 68 governed, which is governed by the section 60, that transfer of income without transferring of assets. In that case, we will discuss it later. The second situation is this: A is the owner of asset and he has transferred the asset to the B, but that transfer is revocable. Revocable, what is the revocable transfer? What is transfer? We will discuss it also later on. The second situation is this, which will be covered by section 61 of the Income Tax Act. Transfer of asset, but the transfer is revocable. Third situation is this, which is section 62 and 63 will be part of section 61. 64 1 class 2nd will deal the case when an individual who is having substantial interest in any concern, and that concern gives remuneration, salary, commission, bonus, whatever the form of remuneration, to any person, to the spouse of that particular assessee, then in that case, and spouse does not have any technical knowledge, technical qualification, professional qualification, that is the third situation, 64 1 second. 64 1 4 is the situation when the assessee transfer asset without adequate consideration. In that case, what is going to happen to the assessee? We will take up this case to the spouse, and if that transfer without adequate consideration is son's wife, that is another thing which we will take consideration. Minor child's income, we will take some transfers to the person or association of persons by the assessee for the benefit of spouse or son's wife. That are the 2 points. And HUF, hodgepodge transfers, or the that what is the position in that case. So we will take up each one by one all these sections. But before that, I would also say that section 5 also says this the same thing, that also talks about the person only. But since there were possibilities of avoidance of tax, so the provision of these clubbing of income have been brought into the statute. So I come on section 60, transfer of income without transfer of asset. So before I come, I would like to come share my presentation. This is section 4. I discussed to you that section 4 talks about the person only, taxation of person only, but to avoid the avoidance of tax, these provisions have been brought. Section 231, I have tried to bring in your notice that what person is. So person includes individual, HUF, company, firm, AOP, local authority, and artificial judicial. We all know it, but just I have given it just to bring in your immediate concern. Section 5, scope of total income, what is taxable in India for the residents. That is again for the purpose of immediate, just for freshness, you just know that section 5 also speaks about the person only. Now we come on the section 60. What section 60 says? Section 60 says, transfer of income where there is no transfer of asset. All income arising to any person, by virtue of a transfer, whether revocable or not. It is very important that transfer may be revocable or not revocable, whether affected before the implementation of this act or thereafter, but there is no transfer of asset. So what are the basics of this particular section? Taxpayer owns an asset. The ownership of asset is not transferred by him. The income from the asset is transferred to any person under a settlement or agreement. If the above conditions are satisfied, the income from the asset would be taxable in the hands of the transferor. So what this section says, this is not a new section. It was in 1922 Act also under section 16 clause 1, clause C section was there. So this is not a new section. The first important thing that there is a taxpayer who owns an asset, but he has not transferred that asset, but has transferred the income. The very purpose to transfer the income was to save the tax. So when the department or the government came to know that the people are doing this thing, they are simply transferring the income. They are not transferring the assets. So they brought this provision कि under these circumstances, when the income is only transferred and the assets are not transferred, then any income from that asset would be taxable in the hands of the transferor instead of a person to whom such income has been transferred. So friends, there are circumstances that what was the purpose? I told you that the purpose was just to avoid the taxes by some individuals, and there is no exception to this rule. This is a general provision which is applicable on all, but it is not applicable where the income is to diverted by an overriding title as a matter of fact before accrual of income. This is a case of Dalmia Cement where it has been held by the court, honorable court, that if the transfer of income is by overriding title, and that is a fact, that is not an that is a mal arrangement. So in that situation, this provision will not be applicable. But if it is so, TDS credit, whatever credit is there, that will be available to the transferor. So this is very important provision, friends. Now, by bringing this provision in the Act, what has been held there, that if a taxpayer transfers income, again I am repeating, without transferring of assets, in that case, that income which the assessee has tried to transfer to another person to save the taxes, to avoid the taxes, that purpose will not be fulfilled of the assessee, and that income will be taxed in the case of transferor. So this is section 60, which is very important, friends, and I think we should take care of this section whenever we go for the filing of the return of income this year. We find if any arrangement, suppose A transfer rental income of a property to his brother without transferring that property in the name of brother, just to save the taxes. And mainly the taxes become more in case of transferor when he is coming in the high bracket and the person to whom this arrangement has been made is coming on the lower brackets. So in that case, it will not be fulfilled because of section 61 and section 60, and the transferor will have to pay the taxes. Now I come on the section 61. 61 is a revocable transfer of an asset. Revocable transfer. Before I come on section 61, I would just like to tell you what is the transfer and what is the revocable transfer. So section 63, it is very unique provision, friends, when in that particular chapter, for the purpose of section 60, 61 and 62, the Act itself has defined the transfer and revocable transfer. So what section 63 speaks, I am telling you this first because we should understand what is revocable transfer and what is transfer for the purpose of section 60, 61 and 62. So first I will take transfer. What is transfer? Transfer includes any settlement, trust, covenant, agreement or arrangement. So there is a very vast definition, friends. It is not a simple transfer as envisaged in our Act, Income Tax Act. Here, for the purpose of section 60, 61 and 62, transfer includes, inclusive definition is there, settlement, trust, covenant, agreement or arrangement. So this is transfer for the purpose of these three sections only. Whenever we will come on section 64, this definition will not come into picture. This definition will not work. Their transfer is separate. Here, for the purpose of section 60, 61 and 62, transfer includes any settlement, trust, covenant, agreement or arrangement. What is the revocable transfer? When transfer will be deemed to be revocable, it is a deeming provision. So what section 63A says, a transfer shall be deemed to be revocable if it contains any provision for the retransfer. Whatever has been transferred, has shown to be transferred by the transferor, has a provision that at any point of time, either income or asset which has shown to be transferred to the transferee can be retransferred to the transferor, whether it can be directly or indirectly. It can be whole or any part of the income, or it can be entire asset or part of asset. In that case, it will be treated as a revocable transfer. It will be deemed revocable transfer. Second one, it in any way gives the transferor a right to reassume power directly or indirectly over the whole or any part of the income or assets. If the agreement through which the transferor has allegedly transferred that asset, that particular agreement gives transferor a power, a right to reassume the power directly or indirectly over the whole or any part of the income or assets. It is also directly, it may be directly, it may be indirectly, it may be for the whole income, for whole assets, part of the income or part of the assets. Then even it will be treated as a revocable transfer. So these two definitions have been given in the section itself, section 63 of the Income Tax Act under chapter 5, which is applicable for the purpose of section 60, 61 and 62. So we should understand that 61 says revocable transfer of asset. So we know from 63 that what is revocable transfer. So now this section says if transfer of an asset is revocable, so whatever transfer is there, if it is revocable, then income from such asset is taxable in the hands of transferor. So again, it is a clubbing provision. If the transferor has transferred the property, but that particular transfer of an asset is revocable in nature, in terms of section 63, then from that asset, if any income is there, that will be taxed in the hands of transferor, not in the hands of transferee. One more important thing, we read in section 63 that it in any way gives the transferor right to reassume power directly or indirectly. This, what that particular section says, that right to reassume power. This is very important, friends. But I would like to tell you that very important fact which is emerging here, that simple provision of reassume the power is sufficient. What I want to say, that actual exercise of power is not necessary. Suppose there is a power that after some time the income will be given to the transferor. There is a provision only, but actually no such income has been transferred to the transferor. But this is not necessary. Honorable Supreme Court, in the case of CIT versus S. Raghuveer Singh, an old, very old case, in 1922 Act case 57 ITR 408, it has said that simply provision is there, then even that transfer will be revocable transfer, and actual exercise of power is not necessary. Actual implementation of power is not necessary. Whatever has been written, whatever has been is coming out of the actions is sufficient, and that particular transfer will be treated as a revocable. Actual exercise and actual implementation of that particular provision is not necessary to hold that particular transfer revocable. Third one, where no absolute rights are given to the transferee, and assets can go back to the transferor in some circumstances, transfer is revocable. If rights, it has been shown that property has been transferred, but rights are not absolute to the transferee, and there is a provision that asset can go back to the transferor in some circumstances, then under those circumstances also transfer is revocable. So friends, 61, we discussed 60 says transfer of income without transferring of assets. Section 61 says there is a transfer, again to avoid the income. What happened? After the insertion of section 60, people started to make the transfers of the assets, and they started to avoid the income tax on certain incomes. But when the department or the government came to know these type of tactics by the assessees, then they brought this provision that even there is a transfer, but that is not irrevocable, that is revocable, then also income will be clubbed in the hands of transferor. There are few exceptions of this particular section 61, which are enumerated in section 62. That in these circumstances, transfer will be treated irrevocable, and the provisions of section 61 shall not be applicable. Number one,
Clubbing of income.
By way of a trust, transfer is there, transfer by way of a trust which is not revocable.
HR is given to meet the
Hello?
cost of the income tax.
Hello? Please mute. Doshi ji, who is on?
राजभाई म्यूट कर लो.
So I was discussing the exceptions to section 61. Section 61 talks about revocable transfer of an asset, and if transfer is revocable, then the income will be taxed in the hands of transferor, not in the hands of transferee. But there are few exceptions to section 61 which are enumerated in section 62, which the heading is transfer irrevocable for a specified period. If transfer is there and there is a provision that will not be revoked during the lifetime of transferee, if the transferee is trust, lifetime of the beneficiaries, and if the transfer is to another person, then during the lifetime of transferee. So there are two situations. If transfer is to trust, and that particular asset transfer is not revocable during the lifetime of beneficiary, or if the transfer is to any other person, then that is not revocable during the lifetime of transferee, then under those two circumstances, the provisions of section 61 will not be applicable. And these will be there, these income, if any income is there to the trust, where there is a provision that the trust, that particular asset is not revocable till the lifetime of beneficiaries, and if a transfer is to another person, any other person, then if the asset is not revocable, transfer asset is not revocable during the lifetime of transferee, under these two cases, the income will be taxed in the hands of transferee. It will not be treated as a revocable transfer. But there is a provision. Provision is this, that the transferor derives no direct or indirect benefit from such income in either case. There is a provision that this asset will not be revocable during the lifetime of beneficiary or any other transferee, but the transferor is getting some direct or indirect benefit from out of such incomes, then this provision, this shelter will not be available to the transferee, and the income will be taxed in the hands of transferor only. So this is the these are the two conditions. Third condition is not applicable today, but I would like to tell for the academic purposes that if the transfer was made before the first day of April 1961, the date when this Income Tax Act 1961 came into institute, and there is a provision that this particular transfer of asset will not be revocable for a period of exceeding 6 years. It revocable less than up to 6 years, then also this provision, this shelter was there, and the particular transfer was not treated as revocable. So these are the three things, three exceptions to the section 61. All three exceptions are section 62, but again the condition is there, and very specifically has been told that okay, we will treat is irrevocable. We will not treat is revocable transfer, but there should be no intention, provision, and a transferor should not derive any direct or indirect benefit out of such incomes. And again, I would like to say that income of transfer when power to revoke arises, when if there is any provision in that transfer agreement that that particular transfer can be revoked, then again the problem is there, and in that case also the income will be taxed in the hands of transferor, not in the hands of transferee. Friends, what section 61 says? 61 says simply that it shifts the liability of tax from the beneficiary to the tax transformer, but it does not change the nature of income. If the income is exempt from income tax, then there will be no tax in the hands of transferor anyone. One more thing which is very important, if the benefit, the alleged benefit is very negligible, illusory, very small, then again there is a decision that it will also be out of section 61, and in that case also the taxes will have to be paid by the transferee, not by the power to revoke. Again, friends, what I personally feel that this is a power which should be broad in the sense. It should not be restricted, because otherwise it will lose the purpose of the bringing the same provision. I would tell you some of the examples of section 61, 62 and 63, which will make it more clear to you. With some case laws. In the CIT versus Kika Bhai Premchand case, which is very old case against 16 ITR, there was a trust, and there was terms of the trust that there would be a power of loan to the trustees, and power of loan to not to the general public only, power of loan to the trustee also, to the settler also. So in that case, and there was also provision that there will no security for that particular loan. So there was a trust where power was given to the settler that he can grant the loans not only to the public but also to settler or trustees, and that too without security. So it was held by the courts that this particular action agreement comes to the net of this particular section 63, direct or indirect benefits. It is indirect benefit from the income of the trust, and I would also like to tell you the facts. In the facts of that particular case, there was a fact that no actual loan was given to any settler or trustee, but there was a provision. So simply because there was a provision, it was treated that it is indirect benefit, and it was held that the provisions of section 61 would be applicable. Next case, Ramji versus CIT, 13 ITR, another old case, because I want to say you friend that jurisprudence in the clubbing provisions is also very old but very important. In this case, a husband made a settlement for the exclusive and independent maintenance of wife. Husband made a settlement for the exclusive and independent maintenance of wife. It was held in that case that it is not any direct or indirect benefit, because a husband has legal obligation to maintain the wife. So these are some important cases which I would like to narrate, and which we should know, because it will work. It will come in our help to us in our working. If a provision is made in the trust that the entire corpus is irrevocable, if a specific provision is made, then also there is no indirect benefit. Right to reassume, we saw the word right to reassume is there. It is on the screen also, that in any way gives the transferor right to reassume. So what is the court has in the case of CIT versus Jayanti Lal, the Honorable Supreme Court in 67 ITR has said that right to reassume power means a legally recognized right. It should not be that which would involve a breach of trust or of law. So reassume power means a legally recognized right, and it should be a part of the deed. So these are some cases from which I try to explain you the section 61, 62 and 63, that if there is a revocable transfer of any asset, and what is revocable transfer, what is transfer, I try to explain you. And if there is a revocable transfer, then income shall be assessed in the hands of transferor, and if it is not a revocable transfer, section 62 is coming to save of the assessee. Then because there was not revocable till the lifetime of beneficiary in case of trust, there was not revocable during the lifetime of transferee, then the income will be taxed in the hands of transferee. So these three sections we discussed, friends. We discussed 60, 61, 62, 61 and 62 and 63, 4 sections. 62 and 63 are the sections which specifies what is revocable transfer, what is transfer. 62 speaks, the exceptions are covered by section 62. Basically, mechanism, two provisions are important, section 60 and section 61. Section 60 says that if income is transferred, asset is not transferred, tax will be paid by the transferor. Section 61 says if asset is transferred, but that particular transfer is revocable, which has been defined in section 63, then also the income will be taxed in the hands of transferor. So these are the two basic sections, 60 and 61. Two sections were the one for the exception, 62, and 63 was the section where what is revocable transfer and what is transfer has been defined. So friend, these are the four sections which we have taken up. Now we come on the very important section, section 64. Friends, section 64 is a section which is very useful, and whenever we go for the filing of return of income, we should take care of this particular section. Specifically, I would talk 64.1 subclass 2, subclass 4, very important friends, and I think we should be very careful. Section, now we are coming on the section 64.1 subclass 2nd. It says, friends, in computing the total income of any individual, there shall be included all such income as arises directly or indirectly. What does this particular section says, friends? This 64.1 second clause says that there is an individual. Number one thing, there is an individual who has substantial interest in any concern. So first thing, individual. So this particular section is applicable only on individual. And second thing, so I want to say that this is not applicable on HUF or any other status. It is applicable on the individual. Second thing, that individual must have substantial interest in any concern. The second condition is that individual should have substantial interest. What is substantial interest? We all know, but I would discuss later. Third important thing, that concern pays salary, commission, fees, or any other form of remuneration to the spouse of that individual. If individual is husband, to wife. If individual is wife, to husband. So what three things I told, friends? Individual should be there. Individual should have substantial interest in any concern. And third one, that particular concern is paying salary, commission, fees, or any other form of remuneration to the spouse of such individual. And such individual does not possess any technical or professional qualification, and that particular salary, commission, fees, or remuneration earned by that spouse is solely attributable to the application of his or her technical or professional knowledge and experience. It is not there. Then in that case, that particular salary, commission, fees, or any other form of remuneration paid to the spouse will be taxed in the hands of that individual. So friends, I'm trying to explain the importance of this particular section. This is not a case where only firm, if partner is a partner firm, and that if partners, we are paying any remuneration to partner, that or share of profit will, it is that any concern. The only thing that individual should have substantial interest. What is substantial interest? But before I come on the other things, I would like to tell you that this particular provision was made applicable from assessment year 1976-77. This was made applicable since 1976-77. So it's under again around 45-46 years have gone with this provision, but still mistakes are being happening. Still the assessees are not taking consideration of these circumstances. They are not taking consideration. They are not paying the right taxes in the right hands. So this is the real picture. So thereafter, friends, you see two things here. That spouse, if the spouse possesses technical or professional qualification, one thing, and the income which the spouse is getting is solely attributable to the application of his or her that technical or professional knowledge and experience. These two particular conditions are cumulative conditions. And both of these things should be there. The spouse should possess technical or professional qualification. We will discuss what is technical or professional qualification, and the income which is generating to that spouse, it should be solely attributable to that application of his technical or professional knowledge. So these two conditions to hold that this is that particular spouse should be taxed, and it should not be, the individual should not be taxed. These two conditions are the exceptions, and both of these conditions should be fulfilled, not only one. If only one is there, it will not work. One more thing before I go ahead, I would like to tell you that if remuneration paid to partners are covered under section 28, and that is a business income part, so to me that is not covered under this section, and that is out of this provisions of this section. So what is remuneration? Remuneration is salary, commission, fees, or any other remuneration received whether in cash or in kind. It is very important to tell you that there is no necessity that it should be in cash only. It can be in cash or in kind also. Concerns, all concerns, it covers the professional concerns also. Substantial interest, if an individual beneficially holds 20% or more equity shares in a company, or if there is no company, 20% or more share in profit of concern at any time during the previous. This is very important, friends. At any time during the previous year. If we all know that tax is on the previous year income. So if even on a single day, the assessee was having 20% beneficial interest in a company as a shareholder and 20% or more profit in any other concern, then it will be treated that particular individual was having substantial interest in that particular concern. And at any point of time in any day during the previous year. And individual does not mean individual alone. Individual includes his relatives as defined under section 241 of the Act. So now you just think that now you compare, suppose a person A has 15% of shares, but his brother has 7% of shares, and his sister has 5% of shares. So 3 becomes 27%. That is more than 20%. So if this is there, so it is substantial interest is there. Now one more important thing, beneficially holds. This is very important, friends. If the shareholding of an individual in a company is not beneficially holding, they are having some fixed income only on the holdings, then this particular provision will not be applicable because that will not be treated as a substantial interest. So what I want to say that beneficially holding should be there. It should be 20% or more during the any day during the previous year. And what I'm trying to say again, I want to repeat that individual does not mean alone individual. It includes his relatives as defined under section 241 of the Income Tax Act. So 241 of the Income Tax Act, I think it covers brother, sister, lineage descendant, and descendants. This is a section, friends, which create deeming liability to tax. So this is a settled decision, settled law in the case of Balachandar versus CIT, and a very recent decision 257 ITR, where it has been held that this provision should be strictly constrained. There should be no wide constraint, liberal construction. It should be strictly, what has been written should be treated. We should not go beyond that. Now, friends, we come on the technical or professional qualification. As we read just now that if the spouse possesses technical or professional qualification and that income which he or she has earned is solely attributable to the application of his or her technical or professional knowledge and experience, then this provision is not applicable. Clubbing provision is not applicable, and that the income shall be taxed in the hands of spouse only, not in the hands of the individual. So what is technical or professional qualification? We all understand what does it. Technical means the person should be doctor, person should be engineer, scientist, etc., etc. And professional qualification, we know chartered accountant, company secretary, ICWA, like this. But there is a case, in 1985 case, Bhatta Kalyani versus CIT, which is very important case. But I just want to accept that there are contrary views also. I am discussing here only the case which is favoring us. This particular case says technical or professional qualifications do not necessarily relate to technical qualifications acquired by obtaining a certificate, diploma or degree, or in any other form from a recognized body like a university or institute, like our institute. So what this case says, that professional qualification does not mean that you must have a diploma or degree or certificate. What it means that there should be, what professional qualification means, that the person is having knowledge to do work, that work which is he or she is doing. So this is very important case law which I wanted to discuss with you, friends, that technical or professional qualification, this is the case in our favor, but not generally. There may be some cases which are not in favor of the assessee. They are asking about the degree, that the asking for the degree is important. What another case in the Asa Ben Rohit Bhai versus CIT 237 ITR 561. Again, it has been held that requirement of qualification degree should not be seen in general in terms. It differs depending upon the nature of job, the post occupied by the particular person, and it should not be so strict that there should be a qualification degree. But again, the 240 ITR 773 CIT versus Jaya Lakshmi, this gives some different decision. So we should be very careful when we adopt for this. But I personally feel that there are certain circumstances, suppose a very kirana shop is there, and where the spouse of that person is working, and that is the spouse is the BCom, or suppose she is even not BCom, she is having several experience about the maintaining the accounts, and she or he is maintaining the accounts at that kirana shop. So I think expecting a certificate, diploma or a degree for a work of a accountant in a kirana shop, I think it is some excessive. And I personally feel that this Bhatta Kalyani case and some other cases which I discussed, Asa Ben Rohit Bhai case of the Gujarat, that will work and that will come to our rescue. One more important, we discussed it that this particular provision is applicable for the spouses. Yani, if husband is individual, then wife is spouse, wife is individual, then husband is spouse. So what is important and which it should be taken care of whenever we go for this, that relationship of husband and wife should subsist at the time of transfer of asset and at the time when income is accrued. This is again a very important case. Now, this is another explanation there in the provision. Then, when both the husband and wives have substantial interest, we discussed a case where one individual was having substantial interest, another, and the spouse was getting the remuneration. Now the case is there, the both husband and wife are having substantial interest, both are getting remuneration, then what will happen? So it is it has been mentioned therein that in that case, the who out of both has the greater income, the clubbing will be in the hand of the that particular individual who has the greater income. And once clubbing is done in the hands of one of the person, whether husband or wife, it will be included in their income in subsequent year also, except when the assessing officer has powers to issue the notice, but only after giving the opportunity of being heard to the assessee, that assessing officer can say that he wants to change the hands of the taxation. But what I personally feel that it cannot be done simply because the tax is lowering in the present situation. Because there is circular number 258 dated 14 June 1979. That particular circular says that this provision is applicable even if resulting tax liability is lower, because it may happen sometimes that tax what could have been paid to the government through the exchequer without bringing these clubbing provisions in action was more than after bringing the clubbing provisions. So even after doing the clubbing, resulting tax liability is lower, then also this particular clubbing provisions will be applicable, and has to be dealt accordingly. I told you there are the case of Supreme Court also, that Philip John versus CIT 49 ITR 97 Supreme Court, which say that relationship of husband wife should subsist at both the times, when there is a transfer and when there is accrual income. Now friends, we come on the section 64(1) clause 4. So we have discussed three basic clubbing provisions up to now. Section 61, 62 and 3 were the part of 61, and there are 64 subsection 1 clause 2, which was the individual having substantial interest in any concern, and that concern is paying remuneration to the spouse of the particular individual, and that particular spouse was not having any professional or technical qualification, and that individual spouse was not using that professional or technical experience or other things for getting that income. Now it is the 64(1)(2), 61(1)(4)(1)(4). What it says, friend, that 64(1)(4) is the again clubbing provision, which says that when any asset is transferred, and that is not to the spouse of that particular individual, and that is without adequate consideration. I can repeat, an asset is transferred directly or indirectly to the spouse by such individual, otherwise than for adequate consideration or in connection with an agreement to live apart, then in these conditions, whatever the income that asset earns will be taxed in the hands of transferor. So basic conditions are: taxpayer must be an individual. Such individual has transferred some asset, and it should not be house property. Because why it is not house property, should not be house property? Because section 27 of the Income Tax Act 1961 deals with the cases where house property has been transferred without adequate consideration, and taxation of this house property will be under section 22 of the under income from house property act. So that's why section 27 is not excluded here. So taxpayer is an individual. Such individual has transferred some asset, and that transfer is without adequate consideration. That transfer of that asset is without adequate consideration. Transfer may be directly or indirectly, and form of asset may be changed subsequently. Very interesting topic, friends. Very interesting. And if you will search, you will find at least 5-10 cases of your clients, at least, who are doing these things and not taking care of and giving tax in the right hands or right tax amount. So what I want to say here, I'm giving you an example. Suppose an individual purchases a residential house in the name of his wife. Suppose an individual purchases a house, or I can say shop, in the name of his wife by his money. What will happen to that case? This provision will attract or not. We will see several such type of cases in our professional life. We will find several cases. The person has purchased the house in the name of wife. Person has transferred cash to the bank account of the wife, or wife has transferred cash to the bank account of the husband, and that the wife has used that case for purchasing some property, and that property is yielding some income, and that income has been shown by the wife only or by the husband only. Those assessees are not taking care that there is a clubbing provision. There is a provision that if asset has been transferred without adequate consideration, if gift is there, if there is no loan, if there is no agreement of paying money, so that will be treated as without adequate consideration. And each such case, friends, will come under the purview of this particular 64(1) subclass 4. So we should be very careful whenever we file our return of income of our clients, and we see that there are transactions in the bank in the name of wife. There are some property purchases in the name of wife when the money has been used by the husband only, or wife has used her money to purchase the house in the name of husband. So all these cases we should take care of that whether these provisions are applicable or not. If applicable, we should take care that right taxes and in the right hands tax should be paid. What I want to say you that form of asset may be changed subsequently. It is very important. Form of asset may be changed subsequently meaning thereby that suppose a cash gift was given, no income. Suppose the money was kept in the current account, no income was there, no issue. That cash was used to purchase some FDR by the spouse. Interest is there. Who will pay the taxes on that interest? The transferor, because that gift was without adequate consideration. Later on, that FD was broken and a property was purchased. Rental income is there. Who will pay the tax on that rental income? That money I am talking about, that only money is being used. Again, the transferor will pay the taxes. And suppose that particular property which was purchased from that money, which was given gift, was sold, capital gains, tax. Who will pay that tax? Again, transferor will pay that tax. So this is a chain, friends, that every time income is there on the asset which has been given to the spouse without adequate consideration, income will be of the transferor. I think you must understand the importance of this particular provision, and you will definitely be careful whenever you go for the filing the return of income of such assessees who are doing frequent transaction with the wife or wife with the husband, transferring the cash to their accounts, and those are being used in their businesses, etc., etc., etc. So if these are the situations, we should be very careful while filing of the return, because we have seen several cases in our board of disciplinary committees, where it has been held that if there is a mistake of chartered accountant filing return of income, it's very not a good test for us. So we would be very careful whenever we go for this work. So friends, when this clubbing of say this 6414 will not be attracted. I would like to tell you few instances. Number one, if transfer is before marriage, if that particular asset was transferred to the would-be wife or would-be husband, then this provision is not applicable. Second thing, transfer is there, but transfer is with adequate consideration. Then also it is not applicable. And when income is earned, income is accruing, then also there is no relationship of husband and wife. So I want to say, friend, that 64(1) clause, subclause 2, which we discussed just now about regarding remuneration part to the spouse, and this particular clause 4, it is mandatory that the relationship of husband and wife subsist at the time when there is transfer of asset and also at the time when there is accrual of income. If none of these two situations are there, this provision is not applicable. One more thing, if HUF, because these two provisions are applicable on the individual, so HUF is there, then also there is no taxation. There is no applicability of these clubbing provisions. One more thing, this is I would like to tell on the basis of several decisions of the court, that there is inadequate consideration, or I can say there is no adequate consideration. But what is adequate and what is inadequate, we can find out. So whether the entire amount, entire asset income will be taxed in the hands of transferor, or the part which is inadequate pro rata basis will be taxed in the hands of transferor. So there is a case law, Palvardhan versus CIT, 76 ITR 279, later followed 102 ITR, 194 ITR, that it should be proportionate part. Suppose an adequate consideration is 5 lakhs for some asset, but the deal has been finalized in the rupees 4 lakhs. Then that 1 lakh is the inadequate consideration. Inadequate consideration part is 1 lakh. So 1 lakh divided by 5 lakh, 20%. So 20% of the income generated on that particular asset should be taxed in the hands of transferor, not the entire income. There is a contrary decision also, but I think this view, which I also support, is workable more, that always when there is inadequate consideration part should only be taxed. I have told you that if the form of asset has changed, original asset has lost its value, new asset has come in place of the old asset, another new asset has come in place of second one, third one, fourth one, all times it will attract this provision of clubbing, and transferor will be liable to pay taxes on any income generated on that particular asset which has been transferred without adequate consideration. In one case, there was a transfer of land part, and building was constructed by the wife. Then only the part of land only should be, the pro rata basis should be taxed in the hands of transferor. One more important thing, which we all know, our ladies, you have seen the incidents when there was a notebandi in 2016, that our ladies, there were huge cases were found with our ladies. So if there was a savings out of PIN money or savings out of household expenses, and that asset has been purchased by that particular, I would say, spouse or wife by the savings of PIN money or by the savings of household expenses, that will not attract the provision, because this is a case of RB and J Naidu versus CIT. and R. Dalmia versus CIT Delhi High Court 133 ITR 169 case, which also says that in those circumstances when PIN money is there and PIN money has been used, savings out of household expenses has been used for purchase of assets, so there cannot be a assumption that this is also a gift to the spouse by the individual, and that should also be taxed in the hands of the that particular individual. Yes, one more important thing which I would like to say, friends, that loan is a consideration. Therefore, if loan is there, but we should be very careful that simply saying loan will not be loan. We should take care. We should prepare the balance sheets, and we should mention in those balance sheets that you have given the loan and the other spouse has taken that loan, and that the transaction should be through account pay checks or through following all the rules of the Income Tax Act, and there should be some interest part also. So if we want to show that it was a loan and a loan was given, so loan is definitely with consideration if interest is being paid there. So we should take very much care whenever we file the return of income of our individual assessees, and there are frequent transfers to the bank account. There are frequent purchases of the assets. Although after bringing the Benami Act, there is something restriction on the purchases of assets in the name of wife also. But I think Benami also permits the wife's case that properties can be purchased in the name of wife. So that in that circumstance we should be very careful. Just one more thing, friends. One on HUF partition also there is no transfer. So if there is certain need of and doing anything to, we should take care of this also. Profit. It is also important if the income, particular transaction income is exempt. That's a PF. PF, suppose some PF investments have been made by the individual in the name of his spouse, but the income from that PF is exempt income. So that will not make taxable event in the hands of transfer. So this is, friends, I just tried to explain you the provisions of 64(1) clause 4, which speaks about the case where asset has been transferred directly or indirectly by the individual to the spouse of such individual, otherwise than for inadequate consideration. Then if the facts are there, and then income will be taxed in the hands of transferor. Now friends, I come on 64. Before I come, I would like to tell you some more things about the consideration. What is adequate consideration? We have seen several circumstances when we have said several times that natural love and affection is a consideration. So it has been held in the case of Tulsidas Kailash Chand versus CIT by the Honorable Supreme Court in 42 ITR 1 that natural love and affection may be good consideration, but that is not adequate consideration. So what is adequate consideration? Adequate consideration, that the consideration should equal to the value of asset transferred. If it is not there, this will attract. We have seen direct or indirect transfers. So this is, we are seeing continuously what is direct or what is indirect. This is also called cross transfers. And the very popular case is there, CIT versus CM Kothari, Supreme Court case, which has dealt with this indirect transfers. What in that case, it has been said by the Honorable Supreme Court that if two transactions are interconnected, but some of the transaction or part of some of transaction are adopting circuitous method, circular trading method, then it will be called as indirect transfer and section 64(1) will attract. So if it retracts, then again issue is there, and it will be treated that it is a transfer without adequate consideration, and it will be taxed in the hands of transferor. Identity change of transferred assets. We discussed it, but I would like to tell you in some more way that cash is gifted to wife who later made FD of same amount. So what is the result? Interest income is includable in the assessee total income. A case is also Supreme Court Moini Thapar versus CIT 83 ITR 208. That house property investment, rental income if any is taxable in the income of husband. Again a case of the Madras High Court 58 ITR 411 Ganeshan versus CIT. That rental income will be taxable in the hands of wife. Property is sold. So capital gain, if any, shall be again will be taxable in the hands of transferor. And one more thing which I would like to tell you, friend, the transferred asset is invested into business. So that is also covered. Business income will also be taxed in the hands of transferor. You see the consequences, friends. One simple transaction that a husband transferred some cash to his wife. The wife purchased FDRs initially, interest will be taxable. After maturity of FDR, house was purchased, rental income will be taxable. After that particular property was sold, capital gain will be taxable in the hands of transferor. And after that amount received out of sale value, then if that is invested into business, so business income will also be taxed in the hands of transferor. See the consequences, friends. Whatever the form of asset has changed, whatever, in the entire case, the transferor who has transferred that particular cash as a gift or without adequate consideration to the wife, you see the consequences. And it is happening, friends. It is happening. So that's why I requested Chitle sir that to hold this particular session, because this particular clause 6414 is very important clause, and we should take care of that what transactions mutually have been done in between wife and husband, and how we can guide our clients to deal with all such circumstances. Otherwise, sometimes it create a huge losses to our clients. So this is I come on 6417.
नहीं, सतीश भाई,
Yeah.
in earlier clause, हाँ, ये भी थोड़ा explain कर दो कि income on gifted property will not be clubbed.
हाँ, वो मैं कर रहा हूँ, accretion of income.
Yeah,
that I will take, sir. Yeah, that is in my part. So friends, yes, as rightly said by Chitle sir, and I tell him as a leader because he guides at the right time of the right things, and that's why he is different in as our leader. What I want to tell you, friends, that accretion on the income earned. Suppose in FDR interest was there, so that particular interest, suppose a 5 lakh FDR is there, and interest was suppose yearly interest was 20,000. That 20,000 will be clubbed in the hands of transferor. But if any further income on that 20,000 is earned, again repeat, 5 lakh FDR, interest amount 20,000, it will be clubbed in the hands of transferor. But any further income is earned on that 20,000, suppose 2,000 next year, that is not taxable in the hands of transferor. That is the separated pure income of the transferee. So this is Chitle sir told me to share with you, and I think it was the right time when he invoked the provisions of these clubbing, and I think very rightly. So there one more thing, friends, 6416. As we discussed, 6414, this was the transfer to the wife or to the spouse. 6416 speaks about transfer without adequate consideration, directly or indirectly, but after 1st June 1973 to the son's wife. If any transfer is there to the son's wife of such individual, and that asset has also been transferred without adequate consideration, directly or indirectly, then also the same consequence is going to happen. Same consequence which we discussed. But date is after 1/6/1973. So we should be very careful. Rather, friends, I would suggest you that you should ask your clients very specifically that is there any transaction with your wife or your husband? Is there any transaction with your son's wife? Is there any income of your minor child? And it very specifically questions should be there, and after getting the answer, we should try to advise them what should he or she do when while filing their return of income. So this was the 6. So I would not discuss because whatever the points here we have discussed at the time of discussing clause 4. Now 64(1)(7) and 8 both are these are extended provisions when the assessees made a scheme that how we can receive the government's provision. They started to make the transfer to other persons, and the income should go benefit for the spouse in one case, and income should go to for the benefit of the son's wife in another case. 7 is the benefit for income goes to the benefit of spouse of the assessee, and this 8 income go to for the benefit of son's wife of the assessee. What people started to do, they started to transfer the assets to another persons, to AOPs, without adequate consideration, and made the provision that income will go to the benefit of spouse or benefit of the son's wife. The government plugged all those loopholes and brought these provisions that even if the transfer is made to a single person or association of persons, and without consideration, adequate consideration is transfer is there, direct or indirect, but the income is going for the benefit, immediate benefit of or deferred benefit. In there, both type of benefits are there, immediate or deferred of the spouse. Then also that income will be taxed in the hands of transferor. It will be clubbed. So this is also the same provision, same things which we have discussed earlier will work here. So what I wanted to say here, that if any transfer by an individual is made to a person or AOP directly or indirectly without adequate consideration, to the extent to which the income from such asset is for the immediate benefit of deferred benefit of spouse or immediate benefit of deferred benefit of son's wife after 1 June 1973, in that case also clubbing provisions will be applicable and the income will be clubbed in the hands of the transferor. So with these provisions, friend, one more thing which I want to bring your kind notice, and you should be taking that to the extent is very important. In both the cases, to the extent to which the income from such asset is for the immediate benefit. Suppose transfer is of rupees 50 lakhs, but the income which goes to the immediate benefit or deferred benefit is of rupees 5 lakhs only. Then that particular 5 lakh divided by 50 lakh will be taxed in the hands of the transferor. That only part of the income should be clubbed. It is my opinion, and I think it is supported by several judicial announcements. So this is 64(1)(7) and 8. I think everything is clear. If you have any question, you can send it on the chat box, and I think sir will take care of this. And if we have time today, we will try to answer those today. If due to paucity of time today is not possible, we will send the answers to the concerned members who have raised the queries. Now, friends, we come on the another provision, very important provision, friends, 64(1)(a), income of minor child. Friends, I think you must be aware who are in practice since long that there were several provisions regarding minor child as a clubbing of income in the Act. But after 1992 Act, when all the incomes of minor child were held taxable in the hands of parent, either of the parent, then all those provisions have been deleted from the these provisions 64 1 clause 3 clause clause 1 2 3 5. There are 1 3 5. There were several other clauses which were related to minor and other things which have been deleted from the act. So now this new section 64(1) is there, very important section. I think we all are taking care of while filing the return of income and of the assessees who have minor child with them and they are earning. But still, I would request that we should be very careful whenever we go for the filing of return of income. So there are few things which we should take care of. We all know that income of minor will be included in the income of that parent whose income, excluding this income, is greater. Whatever the income we are thinking to take decision of clubbing or not, if we exclude that income, then one parent who has a greater income will be taxed by that particular income of the minors. Second thing, in a section 215 perhaps there, which talks about who is the child. They talk about the child, the adopted child and the stepchild. Both are coming under the definition of in our Income Tax Act that both are the child. So, but illegitimate childs are not covered there. So we should take care of that in case the assessee does not have their own children, they have adopted some child, they have stepchild, or they may have illegitimate child. So we should be very clear that what is included here, what is not included. So we should refer the definition of the Income Tax Act. So one more thing which I want to bring here, where the marriage of parent does not subsist. Suppose by any reason marriage of parent does not subsist, then income will be assessed in the hands of the parent who maintains the child in the relevant previous year, because we have seen several court cases when for some times maintenance is being done by the wife, for some time maintenance is done by the husband. Whoever has done the maintain the child in the relevant previous year, in whose case this particular income of that minor child will be clubbed. One more disputed question is there, but my view is I have given here, but several other contrary views are also there, that if both the parent dies, income of the minor child cannot be assessed in the hands of grandparents. Suppose unfortunately both the parents of minor child died, then what will happen to that income? My view is that it cannot be assessed in any case, in any hand, in the hands of grandparent or in the hands of a relative, or even not in the case, even in the case of minor child. This is my view. But another view is there, backed by some decision of the court, that we cannot leave the income unassessed, and it should be taxed in the hands of the person who is taking care of that particular minor child. So these are the two opinions, but I am of the opinion that it should not be taxed. It cannot. Next thing, once if the income is included in the hands of one parent, it will continue to do so except assessing officer is satisfied to do so by an opportunity. But there are some exceptions that following incomes of a minor child will not be taxed at all in the hands of parent. It will be taxed in the hands of minor child only. Number one, any income earned by that minor child and that particular minor child is suffering from any disability specified in section 80U of the Income Tax Act, like physically disabled, totally blind, etc. Income earned by that minor child on the account of any manual work. Suppose minor child is doing manual work. So that particular income belongs to him only. He will pay the taxes. It will not be clubbed. If the minor child is physically disabled child, then also that income will not be clubbed. that will be the minor's income. Income earned on account of any activity involving application of skills, talent, specialized knowledge and experience. If the minor is having any skill, any talent, you see several cases we have seen, friends, when minor is having the absolute talent, they are doing wonderful, rather they are breaking the records. You see chess, they are playing very good chess. Suppose they earn any income out of any such activities where they are using their skills, their talent, their specialized knowledge and experience, then again the particular income will be not be clubbed in the income of the parents. And this is very important that under section 10 there is a reduction of 1500 per minor child to the parent.
Can you mute it? Chitra sir, mute kara.
One more important thing. What will happen when the minor will attain the majority? That particular year, what will happen? Suppose a minor.
Hello sir, Chitra sir, can you mute it?
Kosi sir, क्या what happened?
चित्रे सर का माइक ऑन हो गया है. Just call. So can you mute it, please?
Time to have.
Yes, sir. You carry on.
Yes, sir. Thank you. So, when a minor attains majority in that particular previous year, what will happen? So, up to date when he's minor, the income up to that period will be clubbed in the hands of parent, and thereafter it will be the income of the minor. So, I think regarding taxation of minors and clubbing provisions, I have made it clear. If you have any issue, you can send your queries on the chat box. We will take care of this. Now, friends, there is a provision. I think last clubbing provision is there, section 64, subsection 2. It is in regards to conversion of self-acquired property into joint family property and subsequent partition. Friends, you know, very important provision, and it has a very big history also. That what happened that several individuals transferred their funds to the HUF, common hotspot account, and so in that case, friends, it was all again to save the taxes. So what happened that if there is an individual who is a member of the Hindu undivided family, and there is separate property of individual, and that day is the 31st day of December 1969, very important date. That particular property being converted by that individual into the property of family. How it can be converted? By giving an impression that it is the property of HUF, and by transferring or throwing the said property in the common hotspot account of that HUF. So under these circumstances, when the department or the government found that the people are using it is a tax avoidance tool, they made it very clear that under that circumstances also the income will be clubbed and will be taxed in the hands of that particular individual, not in the case of HUF. So what this provision has, and I would like to tell you the words. the individual shall be deemed to have transferred the converted property through the family to the members of family for being held by them jointly. The income derived from the converted property or any part thereof shall be deemed to arise to the individual, not to the family. So this is very clear, just to break the loophole, and this provision has been brought. One more thing is here, friends. Suppose there is a full partition, complete partition after this conversion, after this transfer of property into HUF property, there is a complete partition. That in that case, if there is a complete partition or partial partition, that in case whatever share is being given to the wife of that individual, spouse of that individual, then any income on that share of wife will be taxed in the hands of the individual. So these two things are there. 64(2) in case of HUF, self-acquired property conversion into joint family property, one first part. In that case, the complete income of that property will be in the hands of individual. If there is a partition, whether it is partial partition or complete partition, whatever the share has been received by the wife of that particular individual, that in that case, that income which is on that particular share will be assessed or clubbed in the hands of the individual. So this is 64(2). 65 section is also there, as I discussed you in the beginning, but this particular 65 talks about the recovery proceedings, that suppose income is tax is being paid by the transferor or the individual, so recovery will also be made from him only. And as I told you earlier, that there are several things. There's, for example, all the deductions will be given, computation will be done as per the provisions of the section in the Income Tax Act. So, and TDS benefits will be given, refund, if any, will also be given to that particular transferor or the in whose hands that clubbing is being done. So that will also be there. What was the crux of the today's discussion, friends? That we should be very careful while compiling or computing the taxage or computing the income of individuals, and we should be very careful when by taking care of all the clubbing provisions. We should also be careful to have a representation from our assessee that what is expected from us, what is our scope, what is their scope. There is no such action of which attacks the clubbing provision. There is no such transaction which attacks the clubbing provision. So we should take reasonable representations, and we should also define, even in tax matters, the scope of our work. So it will help us whenever some problem comes. So I personally feel that this is we should be very careful in filing the return of income, and we should take care of the clubbing provisions. So this is although time is there, but I think we should have this 20 minutes time for any questions is there. Otherwise, I would hand over the proceedings to Atul sir for his remarks, or Chairman sir is also there, and if any question is there in query, then let me know. Thank you very much.
Thank you very much for your thank you very much for your detailed and in-depth analysis of the subject, and you have made it much clear to the participants that clubbing provisions how much important, and which is very useful in the day-to-day practice. Before I go to the vote of thanks, I'd like to raise one issue that regarding that, and our question answers. The 64 subsection 1 clause 2, which is what you said in the beginning, which was added in this 1976 somewhere. That time the situations were no, most of the females were housewives and all that, and business houses were diverting their income to their departing to their wives. At that time, the situation was that. But now, after this 30 years of span, the situation has been a lot of change, and most of the working women are there. And in this situation, really, that section needs to be revisited. I appeal to the chairman, sir, to think on this issue, because nowadays most of the you have given example of one trading concern of kirana shop or sari dukan, where husband and wife both are working, but it's very difficult for them to see that technical and professional competency, and it is to it, because there are so many controversial decisions also. So, and at that time in 70s, that time was there was not joint families were there. Now the families are nuclear, so most of the whole family works in that shop and all that. So that needs to be revisited. Before we going for question and answer, we have several questions. So, Chitra sir, would you like to speak anything?
No, you can we go ahead with question and answer. It was a very elaborate discussion. I would only expect that we will come out with the Direct Tax Committee one small booklet on clubbing provisions, and I would request Satish Bhai to have draft prepared so that we can publish it through our DTC.
Yes, sir. Sure, sir.
Yeah. Then we go for.
You can form a group in Jaipur, and then we can.
Okay, sir. Thank you, sir.
Thank you.
Okay, one question is that when house given on rent, client has given advance, whether that income on advance can be shown in the wife's account for the query raised as above. Sorry, and that wife provides 50 lakhs as a gift via banking mode to the husband for purchase of embroidery machine. Will income out of business income from use of purchased machinery will be covered in the hands of wife? Means wife has given money for purchase. Husband has given, when wife provides rupees, wife has given a gift of rupees 50 lakhs for purchase of some machinery, embroidery machinery. Out of that, income has been generated.
Yes, sir. 6414 is very clear, sir. And 6114, sir, any amount, any transfer without adequate consideration. For whatever purpose the amount has been given. But that is a gift. That is without consideration, without adequate consideration. So that way, clubbing provisions will be applicable. If any income is there on being running of that particular machine which was purchased by that amount, will be taxable in the hands of transferor.
Okay. Then
only the question refers to business income. What one will have to see is if only machine is given on hire, on gift. So income attributable to machine will have to be calculated, not entire business income, because business income.
Yeah, only income of that machine only.
One question is how to deal with income information seen in the form of 26 AS, TIS and AIS in ITR of transfer. That is a technical problem right now, because no income that's for that there is one quick regarding that, because the AIS will reflect in the name of wife, and if it is to be clubbed in the name of husband, how that credit will be taken.
This problem has its own solution, but I think we cannot help here. Chandrasekhar Chitle sir will help here by writing a letter to the CBDT that how it can solve the problem.
I think as far as credit for TDS is concerned, section 200 is there, and it does state that credit will be available to the beneficial owner, and you will find appropriate columns in the ITR that in your name, others' name, wherever you are not living. But practically it becomes difficult, but theoretically it is possible, and also ITR includes certain columns to this effect.
By writing a letter, we can claim that refund. No issue.
Okay. One more question. If transferor dies after gifting the, then what will be happen?
And clubbing will stop. Clubbing will halt.
Yeah.
Okay. One question from Subodh Kwarkod. While auditing under section 44AB, we frequently see that the assessee is paying salary and commission to family members. and tax is also deducted, paid. We have also reported in 48(2)(b). What is our role as an auditor with reference to 64(1)?
Actually, we should not correlate all these things. We should see the provisions of 64(1) second or 61(4)(1)(4). These are the very important provisions. We should see that whether there is a substantial interest in the concern has paid the remuneration, and then only the clubbing provisions will attract in 64(1)(2). And 61(4)(1)(4) is also clear. So we should see the basic conditions of these provisions. It is not important, and what is 44A is okay. But if there is no substantial interest of the individual and in the concern who is paying the remuneration to the spouse, then this particular provision will not be applicable.
Let us take, I think the intention of the query is like that. Mr. X is proprietor and he's paying salary to his wife. Okay, and he's deducting TDS and also that. In that case, he is reporting in the 44AB because of the all provisions of that. 48AB is also reporting. There is no column in the 44AB regarding 64(1), I think. So he is stating that what is our liability.
Sir, there is a column. You read clause 28, which states that any other income not credited to profit and loss account.
Yes. No. That will be in. It's there. Any item which is not included in the capital account. Yeah.
There should be a column to mention the 64(1) relationship, whether there is a tech, but there is very difficult, sir. Doshi, then the question will come about the technical qualifications of the person, professional qualification of the person. Suppose we mention that there is a substantial interest or not. Suppose there is a provision in a column in that particular part, but otherwise then there are a few more questions will be there. I think while filing the return of income, we will have to take care of these provisions. We will have to see with that particular angle. We should not take the shelter of the audit report, etc., etc.
And also let us try to understand. That if the TDS is not made, even if clubbing is there, TDS is not dependent on clubbing. Even if there is a clubbing, TDS has to be made. So Queries has rightly raised this point.
I think that Queries' concern is about that audit report.
No, I understand.
Yeah.
He wants the column to mention.
No, exactly. Column is there. 28 column is there. It asks any other income not credited. So this is income because it is getting clubbed. So it will be perfect carry. Income does not mean what you receive. Even expenditure disallowed is also income. If you refer to definition of income in concealment, etc. So there it can be mentioned. And if supposing some salary is paid to the spouse, and you believe that, or you are not able to make the decision whether it is includable, not includable, maybe appropriate remarks can be made in Form 3C or 3CB in paragraph 3 or 5 that in respect of this, there is no substantial interest, or maybe we believe that considering professional qualification, it is reasonable, and therefore it will not partake character of income of the assessor, something like that.
Okay, one more question. If I take a life insurance policy in the name of minor, what is the tax implications regarding 64?
64 1 second or 1(4) is not applicable on minors. 64 1 is there, 1A is there, that talks about the income of the minors. I think no issue.
See, not only he will get deduction under section 80C also for such insurance payment.
But I think that 20% and less that amount is there, and
no, exactly. So that will be seen.
It will be taxed in the hands of whom?
No. See, there are two things. One is proceeds of insurance. If they are exempt under section 10, even if after clubbing it will be exempt. Yes. If it is taxable, then it will be taxable till the minority. If he attains majority, thereafter clubbing may not apply.
Yeah.
But there is one, in case of daughter-in-law, the clubbing continues.
Yeah.
A company has paid salary to director. A company has paid salary to director and his wife. Okay, wife does not have professional qualification. Whether salary of wife will be added in the hands of He is said company, but I think that he must have intention to that about husband. He said a private limited company. When
No, in
husband
case
and
of
wife
company, it will
realizes-
not be income. In case of
Yeah.
company, it will not be income. And if you have listened presentation by Satish Bhai, then it is clubbed in the hands of husband.
And I think what about receipt of by son's wife in the partition of HUF property originally belonged to the father-in-law for the clubbing provisions?
Repeat, sir.
What about receipt of son's wife? Some amount has been received to the daughter-in-law. Okay, out of the property of father-in-law. In this
Property of HUF.
partition
Property
of
of
HUF.
HUF.
Yeah, property of HUF. Partition of HUF.
Actually, again, property of father-in-law.
Yeah, but I think
There is some
daughter-in-law will not receive
confusion.
it. Basically, as per HUF, that it will be whether it will be received to daughter-in-law. It will go to son only.
And with assessee individual has given gift of that particular property to son's wife. This is the case,
No,
now.
I think that query, he has not mentioned that. I think Mr. Mahaval has not. He said, what about receipt of son's wife in partition of HUF property originally belonged to father-in-law for father-in-law?
Clubbing.
HUF, on the partition of HUF, these provisions are not applicable, sir.
Satish Bhai, as you explained earlier, where father-in-law has gifted his property, blended his property with HUF property, and on
That is-
partition, this property is received by daughter-in-law.
That is not taxable in the hands of that transferor. Only wife's shares is taxable, sir. In case of HUF. On partition, if son's wife gets any share, that is not taxable in the hands of transferor.
One big question is there. Client has purchased house in the name of wife and husband by selling jewelry of wife. But the trader's husband, that is 26 years issue. That PAN has been missed. That is PAN is required. Okay. Gift to HUF from co-personal members and gift from HUF co-personal. Clubbing provision, I think this is already covered. Gifting of co-personal. I think such question is completed. Question is completed. Should I go for vote of thanks, sir? I think, sir, I thank you. Thanks to the chairman of the Directors Committee who was present whole of the session itself here and guided to us on various subparts. And I also thank to the speakers, Satish Gupta ji sir, who has spared valuable his time and given in-depth analysis of this untouched area of clubbing of income. And we also thanks to all the participants for the present over here. Thank you very much.
Thank you. Yeah, thank you, Atul Doshi, former chairman, Satara branch. You have been you have really conducted this national
And
webinar.
I also thank you for giving me opportunity to you also. Thank you. Thank you.
Yeah, and our vice chairman was also there.
Yes,
and
Vice Chairman.
as we note that this presentation was very useful, and we believe that if a small booklet can be brought out by DTC, it would be very useful for participants. And maybe I would appeal participants that you send your questions on this particular topic to dtc@ici.in, so that we will also include those question answers in our publication.
Okay.
Okay.
Okay. Thank you, sir.
Thank you. Good night.
Thank you.